Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. I'm trying something new this episode, which
Wearing
only,
a hat.
which only our YouTube viewers will tell. You always wear a hat.
I do.
Even though we're inside.
It's merch.
And you have a luscious head of hair.
And it's our walking disclaimer.
Whereas
Not financial advice.
Me, no hair.
Yes.
Don't want to be a walking cliche as a bald man that always wears a hat.
Fair.
But today I'm trying the hat out, trying the Bryce Lesky out. But you're right, it is our merch, our Basis Points merch, and this is just a natural segue to give Basis Points a plug.
Yeah.
If people aren't listening, go and listen wherever you're watching or listening. It's our show made for financial advisors, but available to everyone, talking to some of the best advisors and fund managers in Australia and around the world. With that natural plug, Bryce, done, let's go on to what we're talking about today.
Today we're going to cover off all the important headlines that are making news around the world. And then we have Mr. Beat Up returning with another beaten down stock to bring to the table, backed by popular demand, one of the segments that is continuously requested by the community. So let's get stuck into it.
News and markets.
Today's headlines: China-US agreed to the concept of a trade deal. Nintendo is breaking records. Zip keeps kicking goals. And the latest trend in corporate wellness. But Ren, let's start with checking in on where things are at with the trade war. And of course, it really hinges between China and the US.
Yeah, so after 2 days of talk in London, they agreed to the framework for a deal, or if we throw back to the debates in the presidential election, a concept of a deal.
Yeah.
I think the main thing to take away for us as investors and just people who don't want a global trade war is both sides have leverage over the other. Generally, they're both big markets and big economies, but specifically the US was feeling the pinch of losing access to Chinese rare earth minerals, and then China was feeling the pinch of losing access to advanced technology from the US, and in particular the technology used to make semiconductors.
Yeah.
Because China is trying to build its own semiconductor industry. So I think it's good news that tensions are lowered, but there are bigger deadlines still looming.
Yeah.
The interesting thing is Lynas Rare Earths, the Australian listed rare earths miner, the only listed non-Chinese player, has had a good year. They're up 30% odd. But they noted that the European car makers were feeling the pinch and scrambling because they couldn't get access to Chinese rare earth metals as well. The US military was calling out access to rare earth metals was going to be an issue. So that's an interesting one to watch because they are ubiquitous in a lot of advanced technology, and China controls 70% of the mining, 90% of the refining.
Market domination.
Yeah.
Absolutely. Moving on, so Nintendo, Ren, is breaking records. They have just released, in the last 4 days since recording, they have released the Switch 2, a gaming console that has now sold 3.5 million units. This is a record for the Japanese gaming company. It's the first release of a console in the last 8 years.
Yeah, you're not much of a gamer?
No. The only game I played was Far Cry on and GTA, but all PC.
Yeah.
And I have a Nintendo 64 at home.
There you go.
Yeah.
So I think Nintendo for me is a fascinating company. So share price is up 37% in the past 12 months, up 144% in the past 5 years. Do you remember back in 2021 when Disney was ripping, everyone would sort of also buy Nintendo because it was Disney is so good at leveraging their portfolio of IP into games and theme parks and movies and TV shows.
Yeah.
And everyone then looks at Nintendo's portfolio of IP, Pokemon, Mario, the like, and says, well, Nintendo should do the same.
Yeah.
But the thing with Nintendo is it's never been able to go back to back. So it has 30 years, 40 years of producing consoles. It's never been able to have two winners in a row. So to take you back, Nintendo 64, very famous. Followed it up with the GameCube.
Yes, a flop.
Bit of a flop.
Yeah.
Then it launched the Wii, in 2006.
Yeah.
God, that was good. Wii bowling, Wii tennis.
Tennis, yeah.
Followed up with the Wii U.
I don't even remember that one.
Yeah, well,
Yeah.
that's why. How about the Nintendo DS, the handheld device? That was big.
I thought that went well, yeah.
Sold like 150 million units worldwide.
Yeah.
Followed up by the Nintendo 3DS.
No good.
Bit of a flop. So then the Switch came out, and the Switch was a successful console. And so Nintendo investors and Nintendo watchers have been worried because they're due a flop. It's been 8 years. It's been delayed. People have been getting nervous. But signs so far look like it's pretty good.
Well, I mean, it's a record.
Well, yeah, record after 4 days. So this is one to watch. I still think Nintendo's IP is seriously under-monetized. The Mario movie came out. That did all right. But,
Yeah.
you know, Pokemon, that's the most nostalgic IP from my childhood.
Oh, see, I was just never into it. All I did was trade cards with kindergarten kids at school.
When you're in year 12.
Yeah. All right. Well, speaking of things we are nostalgic about, Ren, Zip, the buy now, pay later company, back all the way back in 2021. Yeah. So it's raised its full year guidance for the second time, and investors are absolutely piling in. Transaction volume over in the US was up 40% year on year, and as a result, shares skyrocketed 15% on the news, taking it up 109% in the past 12 months.
Yeah, it's wild. I mean, Zip is now a multi-billion-dollar company again. It had fallen, like 98% from its highs. It was $13 at one stage, fell all the way to like 20 cents or something.
Yeah.
But it's back, which is really impressive for the team there to turn it around, become profitable. And a lot of it is based on the burrito now, pay later phenomenon in the US. Have you been following this?
But as in use buy now, pay later for food.
Yeah, so DoorDash has a buy now, pay later option. 60% of Americans who bought tickets to Coachella used buy now, pay later. Like, Americans love credit.
Yeah.
Australia is the land of gambling losses. America is the land of credit card debt. And buy now, pay later as a newer form of consumer debt has really taken off there. And so Zip is a big beneficiary of it.
Yeah.
There is a question about whether the consumer isn't. I mean, they're better than credit cards.
Yeah, I mean, if you're door dashing in four payments, I'd question whether you should be doing that.
Yeah. But Zip is back.
Yeah. Well, yeah. Continues
credit.
to power on.
All right. Well, as always, we're closing out the news by asking sharing a surprising story that has caught our eye. This is a segment that we do in our daily news emails, so you can sign up to that to keep up to date with everything that's moving markets. The link is in the YouTube description. But Bryce, today we're asking about the latest trend in corporate wellness.
Yep.
Now,
Big dollars.
I haven't actually shared this with you because I wanted to get you to guess. So when you think about corporate wellness, companies will fund a lot of things these days. Gym memberships, psychology appointments, flu vaccines. Childcare's good.
Yeah.
What companies are funding childcare?
Internally, they have the childcare in the office.
Oh, yeah.
Lunches.
But Deloitte over in the US has done a new category of corporate wellness that has caught my
If it's
eye.
Deloitte, it's probably bullshit. Big Four.
Sorry to all our Big Four consultants out there.
It'd be like color printing.
Before I tell you, I want you to just have a guess. What do you think? And I'll give you the.
Does it follow just general wellness fads at the moment, or trends?
Not really a fad. I would say like entertainment is probably the category it falls in.
Entertainment.
Yeah.
I have no idea. Like streaming services.
No.
Movie tickets.
No, they will reimburse their team up to $1,000 a year to buy Lego.
What?
Yeah.
What?
Yeah.
What's the justification?
I guess like it's building Lego gets us off our screens and keeps us present and mindful.
Wow.
To be honest, I didn't really read past the headline.
That is fascinating. Feels like there's a kickback with Lego going on.
Maybe. Well, I wanted to close it out by speaking to all our Deloitte.
$1,000 in Lego doesn't go very far these days.
No, but here's the thing. Lego as an investment has been a pretty incredible asset class. There was a study published in 2022 that showed the resale value of Lego has gone up at 11% a year. So I'm saying to all our Deloitte friends out there, use your $1,000 allocation, buy Lego, never open the box, and you might just be sitting on a gold mine.
Speaking of gold mines, I was watching a YouTube video last night. Long story short, this guy is living on an old silver and gold mine in the middle of the US somewhere. He's bought this town.
Yeah.
And his whole thing is going down the shafts to find old Levi jeans that are down in the shafts, because apparently if you find old Levi jeans from like the 1850s when they were gold mining, they're worth shitloads.
Right.
And so this guy spent 5 years trying
And
to
like,
find...
but how many pairs of jeans are down there?
Heaps apparently. Heaps. He's been doing it for 5 years. I couldn't believe it.
What that
Denim
all right.
miners. They can be worth upwards of $100,000 a pair. I'm not kidding.
I believe you. Well,
I'll put a link in the show notes. I'll find it. Yeah.
Thank you. No. We'll include that in Friday's daily email.
Okay.
So if you haven't signed up, sign up,
What the-
and we'll
yeah.
we'll share it. There you go. 2 What-thers for the price of one.
One of the world's favorite software companies has been whacked over AI fears. The question is it a buying opportunity? And Ren, today we are bringing back none other than Mr. Beat Up to help us answer the question.
Mr.
Beat up.
Mr. Beat Up.
I have the beat that describes that moment accurately.
Mr. Beat Up, welcome.
Great to be here.
Or Simon, I should say.
Special occasion.
What's the occasion?
It's the year birthday of the segment.
Oh, really?
All right. Well, before we go down memory lane, just for people who are new to the show, welcome. Mr. Beat Up, Simon, works with us here at Equity Mates, and he has carved himself out a particular niche of finding stocks that the market has oversold. They've overreacted to some short-term bad news, but they have some long-term opportunity still. Their long-term prospects still look good. And it has become one of our most in-demand segments, largely because of your track record, Simon. So as we celebrate your 1-year anniversary, why don't you take a victory lap and tell us about some of the winners?
Okay, yeah. So we've done 9 stocks over the last
Wow.
12 months. Can you guess which has performed best and which has performed
Super
worst?
micro.
Super Micro is up there. If you counted the honourable mention,
Yes, I do.
it's up 140%. But when we actually did the deep dive, 61.
And
So
there's
that's one
a
of
better
the.
one than that.
There's one which is better than that.
So I'm just racking my brain. So Nike and Boeing are both up, but they won't be up more than 100%. Tesla was up, and then it was down, and then it's up a
Weird
bit.
one.
It could honestly be Tesla. Yeah, I'm going to say
Yeah,
Tesla.
it's Tesla. It's been an absolute ride, but it's actually up 80% since we recorded, because we did get it right near the bottom of this cycle.
That's the name of this. That's the idea of the segment.
Yeah.
So you said you've done 9 over the past 12 months, but to be fair, we've had some community suggestions. You've pitched 7. So of those 7, how many are up?
Yeah, so out of the 7, we've had Tesla, Boeing, Supermicro, Coinbase are all up.
Okay.
Novo's flat.
Yeah.
And then Nike and LVMH are down. LVMH the most, 19% down.
Yeah.
5 out of 7, up or flat. Pretty good.
Yeah. All right.
So,
Well, what
let's-
have you got for us today?
We've got a good one today, I think. Creative powerhouse Adobe. They're currently trading at $412. That's of the June 11 close. We're recording this on June 12th in Australia. Market cap 175 billion, so a massive company. They're actually down about 40% from their peak in 2021. Interestingly, they nearly recovered all of that. And then the start of last year, it's been down 35% since February.
So,
Nice.
Yeah. So for people who are unfamiliar with Adobe, Photoshop is probably their most known product. Illustrator, Acrobat,
PDF reader,
PDF reader. What's the video software we use?
Premiere Pro.
And then if you're in the podcasting game, Adobe Audition,
Yeah.
the audio editing.
Huge creative suite.
Yeah.
Yeah.
Massive.
Yeah. And once you download it, it's really hard to get it off your computer.
Yeah, it's good. It's good. It's also really hard to unsubscribe.
Yeah.
Yeah. Anyway,
Anyway.
that probably plays into it. So what's the go? What's
So
the go?
Let's start with why it's been beaten down.
Yeah, there's 3 things really. Is increased competition. So there's affordable alternatives like Canva have definitely taken market share. They've had some slowing revenue growth. Guidance in December they reduced, and that actually caused a 14% plunge in one day in December. So revenue's gone down a bit. But the big one is the impact of AI, and with photo and video related editing services, how's that going to affect Adobe's business model?
Well, that's what you're here to tell us.
Yes.
Exactly.
So why don't you take us through the case for the recovery?
Yeah, so I thought today try a real pragmatic approach and use the framework that you guys actually came up with, which is the 4-step checklist to analyze any stock.
Love it.
The organic plugs are
Love
strong
it.
in
Love
this
it.
episode.
Yeah, and a link will be available in the show notes so you can download this for free and
play
go
along
with it.
Yeah.
Yes. All right. Well, then let's start with the first step, which is to find a company that makes a great product or service. In other words, is the company doing something that customers want and are willing to pay for? That's step number one. So how does this apply to Adobe?
Well, the short answer, I think, is yes, absolutely. I spoke to Emily, who's video editing team. She uses this every day.
Yeah.
And I thought she had a great way to put it. She said that Adobe's the meat and potatoes of the creative world. So what she basically meant by that is it's not like a trend-driven product. It's actually the infrastructure, the standard infrastructure most creators and editors use.
Yeah.
So obviously M is a survey of one. Is there market share data?
There's market share data. So I got some stuff from eToro I looked at, and it says they're around 42%. Canva's around 18%, and then it gets pretty fragmented from there. What was interesting is 87% of Fortune 100 companies and 75% of Fortune 500 companies, so these are the biggest 500 companies in the US, they all have Adobe subscriptions. So Canva's, starting to dominate the consumer small business crowd, but Adobe, they still own that top end enterprise market. And just an example of what they can offer, which perhaps these like AI companies, which are starting to come up, can't offer, is IP protection and data governance. So Adobe actually guarantee that any content created using their tools, especially its new AI tool, Firefly, which we can come on to, won't expose a company to any copyright risk. So anything you create with their tools, you're covered.
Wow.
Nice.
Great.
Well, I think we can give it a tick. You also could have just said, yes, customers are willing to pay for it. They earn $21.5 billion in revenue.
Big numbers.
Big numbers.
So let's go to step number 2. And this is all about its moat or its sustainable competitive advantage. The question is, will the company continue to earn above market profits?
Yeah, so I think there's two things to cover here. I'll talk about the current, and then will it continue with this AI competition piece. So yeah, they've got a dominant brand. They've got such strong pricing power. 95% of its revenue is reoccurring through subscriptions. This blew me away, actually. 89% gross margin. So that's higher than Salesforce, Meta, Microsoft, all these companies which have huge gross margins. And I think if you look at it from like Equity Mate's business perspective, for example, we spend a few $100 a year on Canva.
Yeah.
We spend that in a month on Adobe.
Yeah.
And we couldn't live without it.
No.
We need this software. So Morningstar, they actually rate Adobe as having a wide economic moat because of those things. Always good to have a Morningstar tick.
So that is all the world as it is. I guess the question is, will it continue to earn above average profits? And this is probably where the AI story starts to come in.
So I think before I started doing this analysis, I was like, yeah, AI is going to come after it big time. But when you actually look into it, they're not ignoring it. They're actually spending a lot of money to try and incorporate AI in their tools to keep people there. So for example, they've launched this Firefly generative engine, which you can now put prompts in to modify your edits, your images, graphics, etc. And they're actually monetizing that as well as an extra subscription add-on. So they're saying this is going to increase their target total addressable market, and they generated nearly 8 billion of free cash flow last year. So they actually got so much money they can invest into new service offerings, or if one of these AI tools does really break out, they actually could just try and buy it.
Yeah,
and so
that's what they'll do.
I'd give this one a pass here.
Yeah,
definitely.
absolutely.
I mean, like you mentioned their gross margins before, but their net margins are like 25% plus really every year.
So then step number 3 is, can they take that cash and the profit and reinvest it productively back into the business and actually create additional value?
Yeah, this one's a bit mixed. So there's a few things you guys suggest looking at here. One is return on equity, which is actually, they've got over 40%, which is massive.
Yeah.
But their reinvestment rate, the benchmark you suggest is around 40%. They're actually around 15 to 20%. So that's a bit low, but they are still heavily investing in research and development. So around 3.5 billion a year they're putting into it. And they did try and buy Figma.
Yeah.
They actually failed there because of antitrust laws pushed back on it in the US, but it shows their ambition. So I think They're not reinvesting massive speed, but they are quite strategic and efficient with their capital. So I'd say this is like a moderate pass I've given this one.
Nice. And then to close out step number 4, if we're happy with all of the above, which it sounds like we generally are, the question comes to, is it a reasonably priced company?
Yeah, valuation.
Yes.
So forward P is about 20, trading's about 27. So it's kind of right in there around 25. Things start to look expensive depending on the business. But historically, it trades around 30 to 35 P, so it's lower than its recent history. I did do a quick DCF with Grok. 10% revenue growth, which is what it's been running at for the last 3 years. 8% discount rate. It gave it a value of around $485, which is like 15 to 20% up
Nice.
on where it is now. But obviously that revenue is the big question mark. So
Yeah.
if you reduce that down to a more conservative number, 5, 8%, it'd probably say it's a fair price at the moment.
Okay.
One thing to note is they are doing a 25 billion share buyback scheme.
Classic.
With all this cash they're making,
Yeah.
and that's going to run to March 28. So if you're a shareholder, you know that's going to actually help with your earnings per share because they're going to buy shares, take it out of the float.
Yeah.
The last one's the PEG ratio. This was a new one for me. I haven't really
Yes.
used it before.
Yeah.
So I don't know if you guys can talk me through.
It takes the price to earnings ratio and then divides it by the revenue growth rate. So it's like if you're trading on a 20 times price to earnings and you've got a 20% growth rate, 20 divided by 20 is 1. Traditional finance says that 1 is fairly valued, above 1 is overvalued, below 1 is undervalued. I kind of think for a company like this, you probably reorientate it to like 1.5 is fairly valued.
Okay.
Because if you think about it, like no software company is trading on a 20 PE and is growing at 20%.
Yeah.
Yeah.
Okay. Well, it's bang in there. It's 1.3 to 1.5
Yeah.
at the moment. So again, all these things probably suggest it's not a bargain, but it's not overvalued either. So it could be a reasonable entry point if you like the business, I'd say.
Love it.
I wasn't super excited by
I was
that.
just going to say I bet Ren's bought it. I bet he's going to buy it.
It is like it's interesting. The growth rate, like there's no doubt the growth rate is slowing, and like you wouldn't want to see your revenue growth dip into single digits. But one thing we've spoken about recently on the show is the rule of 40, which is a software company. You want to see its net margins plus revenue growth rate above 40. And between 2016 and 2021, it ticked the rule of 40, but then it's fallen off in the last few years. So that's not ideal.
Okay.
Yeah.
Yeah, it's probably worth just calling out as well. They're actually set to report their Q2 earnings close of business on the 12th of June, US. This will go out on the 16th. So probably the worst time to do this, just as they're about to report. So, yeah, let's see.
You might be locking in the low share price if they have a good report.
True. Let's see.
Well, Mr. Beat Up, you mentioned that M said this is the meat and potatoes of the creative industry. Certainly seems more like the Wagyu with truffle butter, I should say.
Oh my god! And you said I was falling in love with the stock.
Nah, I do like it.
Well, that does bring us to the end of another episode of Equity Mates. If you've got a stock that you want Mr. Beat Up to have a look at, equitymates.com/contact. Hit us up there. Leave us a voice note. Make sure you subscribe wherever you're watching or you're listening so you don't miss future content. But Bryce, Mr. Beat Up, thanks for joining us.
Thank you.
Sounds good.
We'll speak next time.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.